As the market enters a panic mode, as the market continues to sell off, you start to hear people talking about Federal Reserve needing to provide a inter-meeting emergency rate cuts. At the very moment, S&P 500 has been down by 8.5% since July 16th. The VIX Fear Index experienced such a shocking movement on Monday. Its intraday high reached 66. It's the level last observed during the pandemic sell-off. During that sell-off, the VIX reached 84 at one point, and that was on March of 16th, 2020. What's even scarier for me is that the 10-year, 2-year Treasury yield spread actually went above zero on August 5th. The reason why it worries me is that if you look historically, when 10-year and 2-year Treasury yield spread is below zero, of course, we call that a recession indicator. Usually after 2 years, we have a recession. And when does this recession actually happen? It happens usually after the spread goes above zero, right? So at least it was the case for the past 4 recessions, okay? So this is telling us that possibly our upcoming recession is imminent. Currently, market is expecting 0.5% rate cut. In the September meeting, they're pricing in a 74% probability for that. And the probability of a only 0.25% increase in September is only 27%. But obviously, that level of expectation isn't enough for Wharton School of Business professor Jeremy Siegel. He was interviewed on August 5th, where he shared his opinion that the Federal Reserve should be doing an emergency intermeeting rate cut. Right? Intermeeting meaning you start to change monetary policies between the 2 scheduled meetings as an emergency measure to change your monetary policy. Let's take a listen.
This may surprise me. I'm calling for 75 basis point emergency cut in the Fed funds rate with another 75 basis point cut indicated for next month at the September meeting. And that's minimum. The Fed funds rate right now should be somewhere between 3.5% and 4%. Let me give you very simple logic of my position here. At the June meeting, the Fed has said that the long-run Fed funds rate, when inflation reached 2% and unemployment has come up to 4.2%, should be 2.8. That's the normal. 2.8 is the normal Fed funds rate. Well, on Friday, we blew across the employment number. We're at 4.3. That even argues for a lower one. Now, as far as inflation, we're at 2.5%. We've gone down 90% towards the target on the inflation rate. We've overshot the target on the employment. Those are the 2 targets explicitly mentioned by the Federal Reserve. All right. And how much have we moved the Fed funds rate? 0. That makes absolutely no sense whatsoever.
So essentially, he's asking for a 0.75 interest rate emergency cut before the September scheduled FOMC meeting. And he wants another 0.75 interest rate cut on the actual September FOMC meeting. And he believes the Fed funds rate right now should be at the level of between 3.5 to 4%. Instead of where we are right now. To back up his claims, he mentioned a bunch of numbers. Those numbers come from the FOMC economic projection that's released every other FOMC meetings. And the most recent projection was released at the June FOMC meeting. If we look at this column here, it's called longer run. This column shows you the target of everything, right? That's what the goal and the target of everything for FOMC. According to this column, when the unemployment target should be 4.2%, and the PCE inflation target should be 2%. When this happens, the Fed funds long-term rate should be 2.8%, right? And also 2.8 is considered the current neutral rate. But the problem brought up by Jeremy Siegel is that in the latest non-farm payroll data, it shows that the unemployment rate of United States went up to 4.3%, which is higher than the long-term goal of 4.2%. It has overshot the target. And on the inflation front, this is the PCE headline inflation. We have already progressed 90% towards the 2% target because we went all the way from 7.1 at one point all the way down to 2.5. And now if we look at all these progresses, both on the job market and on the inflation front, the Fed funds rate should have moved, right? We have progressed so much, even one of the measure overshot. But the problem is the Fed funds rate hasn't moved. It moved zero, right? It's still at 5.25 to 5.5% range. And that's the basis of Jeremy Siegel's call on aggressive rate cut, emergency rate cut. And this is why he thinks that Federal Reserve is behind the curve. Okay, and I personally think, even though, yes, I fully agree, Federal Reserve appears to be behind the curve, but in terms of doing an intermittent emergency rate cut, maybe we are not there yet, because usually, historically, when an emergency rate cut happens, you need some sort of black swan event to make it happen. For example, COVID-19, or a well-known financial institution collapsing like the Lehman Brothers, right? So right now, just because the market is panicking, market is doing a massive sell-off, we're seeing fear index jumping up. I don't think that's enough for an emergency meeting. At least it's not required at this very moment, but who knows? Maybe it's going to happen in the future. Maybe tomorrow something bad, something major happens, and that's going to require an emergency meeting. Right now, this is the picture that appears in my head because it shows us how the majority of the decline in bear markets in history occur after the Fed pivot, or in other words, after the Fed start to cut interest rate or the cutting cycle begins. And maybe this is the exact reason why this phenomenon happens in history, because Federal Reserve is always behind the curve. Okay, and that's all I want to share with you today. I want to hear your opinion on this topic in the comment section below. Do you agree with Jeremy Siegel's recommendation for Federal Reserve to implement an emergency intermeeting rate cut, and why? Thank you very much. Please don't forget to like and subscribe. See you next time. Bye.